What's up, everyone? Welcome to the channel. Today we are going to discuss the cash flow statement. So what is a cash flow statement? Well, at a high level, it is a summary of an entity's cash inflows and outflows from operating, investing, and financing activities, which we'll describe later in the video. The sum of these inflows and outflows gives you your net increase and decrease in cash for the current period. That net change in cash is then added to your beginning cash balance, which will give you the ending balance, and that should be what you see on the balance sheet for the current ending period. If we take a look at this example, our beginning balance is $72,000 and our ending balance is $146,400, or an increase in $74,400. That net increase would come from the cash flows from the operating, investing, and financing activities, and would be reflected right here. And then your ending would be your 146. Okay, so that's a basic overview of the concept. But why do we need a statement of cash flows? Well, it comes down to the income statement and the two different bases of accounting. When we're using the cash basis, revenues are recognized when the cash is received. So you book that revenue immediately, even if you haven't delivered the product or service. Similarly, with expenses, they are recognized when paid. So if you pay for 2 years worth of insurance, you would book the entire amount in the current year, even though it covers 2 years. What happens is that the cash basis income statement ends up conveying the same information as the cash flow statement. The trouble comes when an entity is using the accrual basis. Under the accrual basis, revenues are recognized when earned, not collected, which means if the customer hasn't paid you, you would book an accounts receivable. And with expenses, they are recognized when incurred. So if you have a payroll that isn't paid until after December 31st, you'd still need to accrue that expense in December because the labor was performed in December and not January. So the issue comes down to a mismatch of when revenues and expenses are recorded and when cash is received or paid. So that's basically why we need a cash flow statement. Okay, so the statement of cash flows is broken down into three main parts, and sometimes you'll have non-cash items. The first is operating. These are the income statement items like revenues, expenses, and gains and losses from sales of assets. Next is investing activities. Some examples are purchases and sales of buildings, machinery, patents, and securities like stocks and bonds. Last is financing activities. These are the items related to how an entity finances its operations. So some examples of inflows would be the sale of common stock or taking out a loan. Examples of outflows would be paying dividends to shareholders or repaying a loan. Interest payments are actually in the operating section because it's an income statement item. It might help to think of interest as a rent payment on borrowed money, and rent payments would be in the income statement and operating section of the cash flow statement. Some examples of non-cash items would be assets purchased with a notes payable. So in that case, you would debit machinery and credit notes payable, or converting debt to equity. So you would debit bonds payable and credit common stock. So there are two methods used to prepare a cash flow statement: direct and indirect. The direct method is pretty straightforward, as the name implies. You take your cash receipts and your cash payments, net them, and you get cash flows from operating activities. Now, conceptually, the direct method is simpler. However, because there can be a lot more transactional detail depending on the size of the entity, it can be much more cumbersome to use the direct method. When it comes to the indirect method, it can get a little more challenging conceptually. The indirect method is used for entities using the accrual basis of accounting, which makes sense, right? If a company was on the cash basis, they would just use the direct method. With the direct method, we are starting out with net income, and then we back out all of the non-cash items that impact the income statement. And that's how we get cash flows from operations. So let's look at step 2. The most common non-cash items that hit the income statement are depreciation and amortization. So why would we add those to net income? Well, because we aren't laying out cash when we depreciate an asset. We already paid cash when we purchased it, and that's reflected in the investing section. So that needs to be added back to net income. Same thing with amortization. Gains and losses are similar. So when an asset is sold for more or less than its carrying value, a gain or loss is recognized. Let's say we have a gain from an asset sale. Why do we need to subtract it? Well, because the cash received for the asset would already be reflected in the investing section. So let's say the asset's carrying value is $1,000 and we sold it for $1,200. That $1,200 is already in the investing section as an inflow. So if we didn't subtract that $200 gain, we would overstate inflow was by $200. All right, let's move to step 3. These adjustments are related to those timing differences between when revenues and expenses are recognized and when cash is received or paid. All right, so let's take a look at how accounts receivable would be adjusted. Let's assume that beginning receivables are 0 and ending receivables are 0. Let's say that revenues are 1,000, and for simplicity's sake, we'll say expenses are 0 and our net income is 1,000. So in this case, there would be no need for adjustment, right? Because we had net income of 1,000 and our collections are 1,000. So there would be no need to make adjustments there, right? Now let's assume our ending receivables is $300. So in this case, we would need to subtract $300 from our net income. Why is that? Well, what this $300 is telling us is that of our 1,000 in net income, we still have $300 that need to be paid to us. So that means we only collected $700 from that 1,000. Okay, so that's why we would need to subtract $300. Now let's say that our beginning AR was $300 and our ending AR was 0. So that means we had some revenues from the prior period that we hadn't collected on, right? So in this case, we know we collected $1,000 because our ending AR is 0. So we must have collected all of that $1,000. And we also collected $300 from the prior period's revenue, right? If we have an ending balance of 0, we must have collected this $300. So in that case, we would add $300. Okay, so that's how you make adjustments for AR. So that's how we do AR adjustments. The principle is the same for AP, although it's done backwards, right? Because it's a liability. It's the mirror image of accounts receivable. Same thing with accrued expenses. If this doesn't make perfect sense right now, that's okay. I'm throwing a lot at you. In the next video, we're going to do some indirect method examples that'll hopefully cement the concepts in this video.